Hey everybody, welcome back. This week we are going to have some fun. I'm going to regale you with some insightful and witty commentary as we dive into a Dave Ramsey video where his caller asks, is $3 million enough to retire on? So that's our plan for today. I'm Mark Tomei, and I'm with Hindsight Financial, and for over 20 years I've been helping people answer these very questions. So today we're going to see how Dave answers some of these questions, and I will hop in periodically just to give my 2 cents, and hopefully you find this insightful and entertaining. Well, let's get started with Dave.
Charles is with us in Austin, Texas. Hi, Charles. Welcome to the Ramsey Show.
Hi, Dave. Thanks so much for taking my call.
Sure. What's up?
So I'm debt free. I have about $3 million, and I'm curious if that's enough to comfortably retire.
Well, it should be. It's a lot of money. Well done.
Thank you.
How old are you?
58.
Okay. Well, we have to define comfortably. And we have to define what you're going to do with this money, because obviously you're not stupid or you wouldn't have ended up with $3 million. But if you suddenly grew stupid, you could get rid of the $3 million real quickly and not retire, right?
Correct.
So, if you had it reasonably invested and lived on that income, obviously you could retire. So if it were me, I would have put that in good growth stock mutual funds, making 11 or 12% and lived off of about 10 or less, which means I would have somewhere around $250,000, $300,000 a year to live on. I think I could struggle through.
Okay. Let's dive into this a little bit. My head wants to explode when I hear this, but let's just start with some of the basics. We're looking at a 58-year-old who's looking to retire on $3 million. So our usual retirement age is around 65, and for most planning applications, we plan to age 95. So usually a 30-year time horizon. Well, today this gentleman is going to be looking at over a 35-year time horizon, closer to 37-year time horizon, and trying to make $3 million last for that long is a challenge, unless you can find these magical 12% mutual funds that Dave loves to talk about. So the 12% mutual fund, what he's saying there is he's got some mutual funds that average 12% rate of return. I would say that would be a great fund. They're hard to find, but it's a little bit irrelevant at the point. So hold with me on this one and we'll flesh it out. He said he was going to live on 10% or less. So his idea is I'm going to find a mutual fund that earns on average 12%, and I'm only going to withdraw 10% each year to fund my retirement. So I'm going to stop him here, and we're just going to dig into this a little bit because I've got some videos on the channel as well about this, but what we need some correlation between corpus or account size, the 3 million, and how much income that 3 million can produce. And in typical financial planning terms or lingo, we will default to a 4% thumb rule. And I don't need to get in on all of where the 4% came from or any of that detail in this video, but just suffice it to say that that's a good starting point, and today's academics are putting the number a little bit closer to 2.8 to 3. You'll hear later in the video where Dave comes back to that and says, if we can't do that, we got a problem. But Dave's thinking we're going to live on 10% rates of return or rates of withdrawal from the portfolio. And when we look at the major study that was done for industry on how this kind of thing works, what you'll see is for a 35-year time horizon, Dave didn't ask, where is this money? And that literally could be one of the most important questions that I don't think he ever really gets around to. But where is the $3 million? Is it in a savings account? Is it in an IRA? Is it in a commercial real estate building? Is it in a Roth IRA? This matters because where your money lives is more important than what it can earn. That's another separate video, but for now, just push the I believe button on that one. But we don't really know where this money is, but we know that Dave's got 12% mutual funds. And for this 58-year-old, his starting advice right out of the gate is take all of your money and put it in the stock market in mutual funds. Now, I don't know a single living retirement planner or advisor that would give that advice. And the good news is Dave doesn't have any licenses to lose, so he can kind of get a little bit footloose and fancy free with his words. But to start out on a 10% withdrawal rate from your portfolio of assets in retirement, according to the Trinity study, which is kind of Bible for for this area of retirement planning, the 10% withdrawal rate in a 100% stock portfolio gives you about an 11% chance of success. So I'll say that one more time. What Dave just told this investor to do is invest all of his money into growth mutual funds earning 12% and live on 10% or less. If I withdraw 10% of my portfolio and I'm trying to maintain a portfolio of at least $1 throughout my entire 35-year retirement and not run out of money, I've got an 11% chance of success using that strategy. Meaning, I got an 89% chance of failure, of running out of money before I run out of time. So I'll step back here and we'll get back into this, but for now, just know that my head is exploding.
And the money would never, and the principal would never deplete substantially during that time, and I could do that in perpetuation. If you can do that, then you're going to be just fine. If you want to put it in CDs and make 2%, well, you're going to have to live on very little while your $3 million sits there and deteriorates in its purchasing power.
Okay, let's come back to this a little bit, because Dave's entire paradigm is I'm going to take and I'm going to build a nest egg. I'm going to save up the $3 million, I'm going to put it in the market, and that nest egg has to produce the income that I live on each year. You hear him say, we don't ever touch the $3 million. So a couple points on that. Number one, why do we have to preserve the $3 million? Because in Dave's example, the only way we're deriving income is from the growth mutual funds that we're invested in. And typically growth mutual funds do not grow 10% a year. They do not put out that kind of income. So you would see a lot of price fluctuation. And when we ask, why do we have to maintain the 3 million? Well, it's because it has to be the engine that produces next year's income. But that also means he never really gets to drink the beer. You've got this portfolio that you've built over your entire lifetime, and I call that the beer. And Dave's telling you got to sip the foam off the top, and you never really get to drink the beer because you need that beer. Well, that's the game he's playing. That's not necessarily the way it has to be. So when Dave's saying we got to leave that 3 million intact, that means when this gentleman eventually passes away, he's going to leave 3 million of some kind of asset to his spouse. If he has a spouse, Dave never gets around to asking that question, but he does mention a little bit later in the video that he's got kids. So I'll assume that there's a spouse at some point. And I will say that if we're preserving that $3 million across our joint retirement when we're both alive, we are missing some very serious opportunity and efficiencies. When you think about how things are taxed, if you have an investment portfolio and you're only taking the earnings off of the top, that's generally going to be taxed as ordinary income. Every year, you're going to pay ordinary income, which is the highest tax that you could possibly pay on these investments, because you're never touching the principal. You are just taking the income off the top, and for the most part, that's going to be taxed as ordinary income. If, however, you were to sell some of your portfolio that you had tax basis in, then you could get some of that money back without any tax whatsoever. So typically investments can become very tax efficient when you're able to spend them down, actually spend the earnings, but also spend the principal, because each year you get a portion of that return tax-free. So it's a little more tax efficient than what Dave's talking about. But even in a bigger sense, another thing to look at this is we have to maintain the $3 million for our family security as well. So that's almost saying that is Dave's strategy for life insurance for this family. See, a lot of times people don't think you need life insurance in retirement because your kids are grown and your house is typically paid off, and those are the reasons that most people say you should have life insurance. What I'm looking at is if I'm trying to maintain a certain amount of money to leave for my family, then doing it through my own investments is the most expensive way for me to create that $3 million death benefit that I leave to my wife or my children. So there are some opportunities in there maybe to come across some of that money a little bit cheaper than what Dave's talking about. But in general, I would say I've got a few problems with the whole paradigm of invest to build a nest egg and then live simply off of the earnings. You're leaving a lot of money on the table during your retirement if you do it that way.
Right. I put about $2 million into the market, and then I kept like $1 million off to the side just in case everything goes to heck and back. I can either, add to it, or, leave that towards, other investments, real estate, because that's how I made my money, was real estate.
I'd probably put it in real estate then.
Okay.
Instead of sidelining $1 million. Because let's just say $1 million makes 10%. That's $100,000 a year you're losing sidelining it.
Okay, here comes the head explosion again. Dave's assumption is if Mr. Phone Caller, I know you've had some success in real estate, but I'm gonna tell you to take 1/3 of your investments for your retirement and drop them into commercial real estate because I can make 10% rate of return. Again, the rosy expectations. I'm all about optimism, and I'm all about using real estate as a tool in your tool chest. But let's talk a little bit about how the real estate thing works, because you're going to see that Dave's going to convince him to go towards commercial real estate. So if you are a single retail investor, just an average Joe off the block, commercial real estate is kind of a daunting investment, right? Those are big projects that are out there that are usually, if they're decent, they're snapped up by the institutional investors pretty quickly. So for the average retail investor to get broad exposure to commercial real estate without taking on way too much risk, they would do that through what's called real estate investment trusts, or REITs. And REITs have all of their own risks and rewards. As of today in 2024, folks that owned REITs over the last 5 years have been in a lot of pain, because our real estate market has done some very unfortunate things to real estate investors. Commercial real estate is a very solid way to go. However, the past years since the pandemic have been a bit of a challenge, and I would never have wanted my retirement assets to be tied up in that type of an asset class. Because what do we remember about 2008 when the markets crashed? Well, we saw real estate values plummet. We saw banks freeze lending, even for good credit borrowers. We saw a trend of society staying home and working from home. So if you're the person that's counting on real estate commercial rents being paid by big companies that put a lot of bodies in chairs, now all of a sudden there's been this big shift away from having that type of real estate. So those values have been punched, and investors are having a hard time even recovering their money back out of these investments in many cases. More on that in a minute.
Right.
So I wouldn't want to sideline $100,000. I'll sideline some of it, but I feel like, if one of the things goes really badly, I think the other one's probably going to be okay.
Okay, flashback to 2008 one more time. If one of those things did really badly, i.e. the stock market broadly lost almost 50%, depending on the asset classes, anywhere from 40 to 50%. But what also happened to commercial real estate? It took the same hit. See, we use this term in investment lingo called correlation. How correlated is an asset with the stock market? And if it moves in the same direction as the stock market, then it's correlated. But if it doesn't, if it moves in the opposite direction or substantially less than the market, we call that a non-correlated asset. And that's always been real estate's place at the table, is a non-correlated asset that doesn't necessarily move in lockstep with the market. But what we've also seen is a big walk in correlation towards being more closely correlated with the market. The more systemic and global we become, the more everything tends to move in the same direction. More on that in a second.
And generally speaking, I would say real estate is a less risky investment overall. But you're a real estate guy. Would you agree with that, Charles?
Yeah, I absolutely would. But it's also, it takes a lot of your time and a lot of your effort.
Yes,
and that's
extra hassle factor.
I just exited.
Yeah.
Yes. There's a lot that goes into it.
Yeah.
I owned. I've done flips. I've done. I sold an apartment building. That's where my main thing came in.
Wow, good for you. But if you were managing it yourself, it was a super high hassle. But if you outsourced the management, right, or hired somebody to manage it for you under your direction, either one, you'd be fine. So it all comes down to, the answer to your question is, can I retire on $3 million? Yes, if you invest it and live off of what the investment creates without touching the $3 million, you're ready.
Okay, another rosy true but rosy statement. If you're able to live off of just the earnings of your investments, then you're always ready to retire. However, what are some things that he didn't bring up? And this is, it's always more of the devil's in the details and what wasn't uncovered, and what would you typically want to know if you're helping somebody to retire. The gentleman is a caller from Austin. We don't know if he's retiring to Austin or if he's going to retire somewhere else. That's always a good thing to know. Are you married? Are you single? Definitely a good thing to know. How old is your spouse? How's everybody's health? That factors in, because in retirement planning land, there's a couple different risks. If your health is poor, then you run the risk of dying too soon. But if your health is good, then you run the risk of living too long. And longevity is a risk multiplier when it comes to money. So if you're going to have a hard time maintaining retirement income for a 30-year retirement, you're definitely going to have a hard time maintaining it for a 35-year retirement. So what is your age? What is your marital status? Where do you look to retire? And how do you feel retirement is going to work for you? Are you in the healthy up and running travel around phase, or are you going to just retire to the chair in the living room and Jeopardy? See, we're not really talking about a lot of these things. Some of it will come up in a minute, but for the most part, I think Dave's just being a little too general with him. And is real estate risky? In order for this caller to have success in real estate, he's going to have to locate the correct and the right real estate project. He's going to have to acquire it for the best possible cost. He's going to have to carry that investment with the lowest possible cost, and hopefully nothing goes wrong during any of the phases of ownership. And then he's going to have to go full cycle and sell that real estate on the other side for an acceptable amount of profit. So when we say, is it safe or is it not, a lot of things have to go right in order for this man's plan to live up to Dave's rosy outcome of a 10% rate of return on your real estate funds. I did a quick check for this guy in Austin, Texas. The current cap rates or profit rates on real estate are running in the 4 to 7% rate, depending on the area code that you look at. But in no place in Austin right now are cap rates close to 10%. And this gentleman would have a very hard time fulfilling what Dave wants him to do.
Okay.
So,
okay.
And great job.
So
what do you need a year to live on?
Thank you.
He just asked him, what do you need a year to live on? We're halfway through this call, and he got to the most important question at this point of the game.
We've been living the whole time on like 50 to 60.
Okay.
The entire time while building this.
Well, $100,000 is, what is that? Is that 3% on $3 million?
Yeah.
Yeah. So surely to God, son, you can do that.
Okay, where did that just come from? where did Dave just come up with 100,000? The guy said I live off of 50 or 60,000. Dave comes up with 100,000 and does some quick math to come up with it's 3% of the total, and then says, by God, you should be able to do that. So it seems like Dave is now drifting back into the safe withdrawal rate concept, understanding that 3 to 4% is probably the right number, but we're finally starting to make some progress as we go.
Yeah, as long as everything doesn't come crashing down. I'm not, I haven't been in the market a long time. I've never.
If everything comes crashing down to the point that you're only
right.
making 3% on your investments, we got bigger problems than $3 million are going to solve.
Okay, how does that help the caller? I always love when people say that. The caller is saying if things crash or if things go south. So in other words, trying to anticipate challenges to his retirement, and Dave just keeps blowing him over. No, hey, if we got that problem, then you got bigger problems. Well, that doesn't help anybody. And all you'd have to do is look at a chart of returns of all the different asset classes to know there will be plenty of times where you're not making 3%. There will be times when you are negative. So again, the whole premise of how he's guiding this gentleman, I believe needs some help. But let's go back to him.
True. Well, I've got 2 kids though too that I got to still put through college and pay for weddings and all that kind of thing.
Oh, well, that's good to know. That kind of came up late in the game. So typically retirement planning, we're past college and we're past weddings. So in the case where we're talking about retiring early, 58, pretty young, but to still have college education and weddings in front of you, Let's see what Dave has to say about that.
So that's kind of my, intrepidation of.
Unless you're dropping $1 million on that stuff, that doesn't even matter.
Holy crap. Did he just say that? Unless you're dropping 1/3 of your entire net worth on these expenses that you've just mentioned to me, doesn't even matter.
Okay.
I mean, what are you going to spend on all that? You should be able to. Again, you should make this money create 8 or 10%, and you got a $300,000 a year income to do something with if you live out of 100 and spend the rest of it on your kids. I mean, you're still going to be okay.
Yeah, I think you just need to plan for it. It feels like I hear a lot of unknowns in your voice, and there's a couple unknowns, like whatever you decide to spend on these weddings or college, just put a number to it, put it on paper, talk to your kids about it, whatever that plan looks like. And then all the other unknowns of like if the market crashes and all that, that's just fear. That's just, we could sit here and run what if scenarios all day, but we're going to go based on facts. And the fact is you've got $3 million, which is enough to live on and pay for weddings and colleges. And you just stand on that. You stand on the truth of those numbers, make a plan for the numbers, and then let that give you.
So we don't want to worry about a bunch of what ifs or anything like that, which is exactly what I thought retirement planning was. We just want to stick to the facts that $3 million is enough to live off of and buy weddings and colleges. So I took a look at it, and in the University of Texas at Austin, you're looking at, for 2 kids, probably about $32,000 a year. So for 4 years. So for those 4 years that you have 2 kids in college, I'll assume that they're about the same age. But that's an additional $32,000 going out the door in cash flow. Remember, you were saying that we wanted to try to live off of 100. He said 100 at one point. Well, 1/3 of that right now is dedicated to college. So how does that work? And how do you continue funding retirement while you're also funding that college expense? And we didn't even get into weddings yet, but you can kind of assume. The deal is, what is the cash flow? It's not the dollar amount. It's not just strict, subtract college from 3 million and you still have a lot of money. We're in a living, breathing portfolio that goes up and it goes down in value depending on what's going on in the market. And you're taking withdrawals each year to fund your retirement, whether the market is up or whether the market is down. Because even in Dave's real estate example of 10%, there will be down years. In Dave's example of 12% mutual funds forever, there will be down years. It's that volatility that hurts the retiree. When you retire, think about it this way. When you're accumulating wealth, the average rate of return is useful for you because over a long period of time, it'll tend to revert to the average, and it's a good predictor of what your investments will grow to. It's a horrible predictor of retirement income because now when we retire and we're drawing money out of the portfolio, it's no longer the average rate of return that matters to you. It's the sequence of returns that matters to you. So if you start retirement and immediately have a few great years, you are in the catbird seat for retirement. But if you start retirement with a down year, take a look at somebody who tried to retire in 1999. We had 3 down years, one of them very down. That's how you start your retirement. Guess what, guys? You don't recover from that. You absolutely do not recover from that. So it's the timing, it's the sequence of returns that matter to you. And it's the percent withdrawal that you're taking from the account. So if you start with a 3 or a 4% withdrawal, that's more in line with what reality will give you for a 35-year retirement. But when you start adding in the college expenses, it's that increase of the withdrawal rate. The greater withdrawal rate that you take from the portfolio, the greater your chance of running out of money before you run out of time. So that's the risk that we're really dealing with here.
Plan for the numbers and then let that give you the confidence that you need versus running these doomsday scenarios because you're in a great position.
So, wait a minute. I got to stay with this a second because this is okay. How old are you?
58.
You told me that. Okay. So you did real estate deals for how many years?
Since I bought my first house when I was 22.
Okay.
And
so
buying,
so we're about the same age and about the same deal. Okay. Except I went broke in between. But
right.
But the point is,
if
the point is, you need to get some real estate stuff going because you have a much higher comfort zone comfort level
Sure.
with real estate than you do the stock market because you know it. You got 40 years worth of knowing.
Okay. 40 years worth of knowing, where as a real estate investor, you are trying to grow net worth, grow income, grow assets, and you have these projects, whether it's a fix and flip, whatever the case is. He's been doing this for a very long time. But to take somebody who is at retirement's doorstep and tell them now is the time to go get into a commercial real estate project, it just defies logic for me. And there's a lot of things that he's saying here that I really wish I could get into his head a little bit further. Like, really, how would you approach the real estate? Is this go find a commercial building and buy it so that you just get checks every month? If so, a lot of competition for those projects, and the single retail investor is typically last in line for them. But there's a lot of ways to buy real estate, a lot of ways to invest in real estate. My point being, the retiree's objective is growth and income. So we need current income today, along with growth. And chasing that with the stock market and real estate, like he's saying right now, I believe he's giving this gentleman way more risk than he can handle.
And you know it inside and out. You're not going to fret if you've got some of this money invested in real estate. And you need to pick some real estate that's not as high hassle factor. The highest hassle factor in the world is a freaking apartment complex. Buy something where they just send you checks. It's commercial real estate. I've got a couple of retail centers, and I've got a couple of office buildings, and they bring me almost no drama. I got 5 houses that bring me more drama than all the other freaking $100 million worth of stuff put together, So
here's a question for you. When we think of this, he mentions the hassle factor, and I think in terms of, what do I want my retirement to look like? And for a lot of people, managing their retirement assets or their portfolio on the way up was kind of a part-time job. For this gentleman, he's getting ready to possibly retire to this $3 million that Dave wants him to put some in the market and some into real estate. And I can't help but wondering, is this gentleman going to enjoy managing commercial real estate in his 70s and his 80s? Will his wife enjoy managing commercial real estate in her 70s or 80s if her husband passes away? So we have to think through these plans. Are these plans manageable? Are they livable? And are they enjoyable as we go through retirement? Because the last thing you want in retirement is to have to worry day in and day out about your investments producing the income that you need to eat tomorrow. So I'm going to let Dave wrap up this part, and I'll come back with a summary.
So you can go get some low drama real estate, and that's going to let you calm down.
That's a really good insight. That's a really good point.
Because
he knows that. He's done it for 40 years.
The reason he's fretting is he moved everything from what he knows to something he doesn't know.
Yeah, no, that's a really good insight.
Well, I'm not sure he moved from what he knows to what he doesn't know. It sounds like he sold a commercial building and he has $3 million. And so now the challenge is how do I deploy that $3 million to manage a 35-year retirement so that we maximize our retirement income, we maximize the income that goes to my spouse after I die, and then we maximize the amount of money that is retained in our family for our children and our grandchildren so that it doesn't go to the government and attorneys and CPAs and everywhere else it normally goes. So let's just kind of wrap this up. I mean, I love the edutainment factor, and there's a reason why Dave is as big as he is. He's got a great big following, and most of what he says is right on. Some of this stuff, I just have to raise some of these issues because it drives me crazy as a retirement planner to see some of the advice that goes out the door on his show. So he kind of summarized it by go get yourself some low maintenance commercial real estate that earns 10% and go buy that. Well, that sounds nice and easy. I challenge anybody to bring me that project. I don't know that it really exists for somebody like that in that space. Dave mentioned he has $100 million. Well, it's a big difference from $100 million to $1 million. And if we're going to go try to find some low maintenance real estate that produces 10%, that sounds like a game that everybody would play if they could only figure out how. And then the last couple things that I'll point to is just some of the bigger risks of retirement that I don't think we get into very often. We always talk about saving for retirement, but it's the actual period of living off of assets where we're not adding new money in. We are withdrawing from whatever assets we have. And that's an emotional risk that I don't think too many people have been really prepared for, because all your life you've watched your account values grow. And that's a good feeling. You're earning, you're saving, it's an accomplishment. But when you start withdrawing it, that's a different deal. Now you're watching your account balances go down. Every bit of bad news is hypersensitized because it affects your future income. So I had mentioned earlier that longevity is a risk. We have to, when we talk about the retirement end of it, we have our accumulating years, then we have our distribution years where we're living off of our assets, and then we have our preservation at the end where we're trying to keep everything that everyone else is trying to take away from us. And I mentioned earlier, if you have a longevity in your family, then you have a long-term care risk that is potentially very expensive. If you're both alive at age 65, there's a 70% chance that one of you at least will require some form of long-term care. And while we hope it doesn't happen to you, we would want to know, how would you want to pay for that? Because in some of these cases where it's Alzheimer's or dementia or Parkinson's, some of those cases are 7 to 9 year stays in nursing homes, capping out way over $1 million. Didn't even get a mention in here, but it is such a big risk factor. And the only other thing I would say at this point is the efficiency factor of just trying to raise a nest egg and never touch it. Just live off of the earnings. There's a lot of opportunity that's being left there, and I think a little bit too much risk for this guy. So drop me some comments below. Love to hear what you think. If this was eye-opening for you, or if you agree with me or disagree with me, I'd love to hear from you. You have a great week, and if you like the channel, please subscribe, comment, like, and share. Do all that fun stuff. Now let's go retire right.